Welcome, everyone. Before we jump in, you'll see a quick note on your screen acknowledging the preparation for today's session. All right, let's get right to it. So, have you ever stopped to think about what really happens, tax-wise, when you sell shares back to the company that issued them? I mean, it sounds simple enough, right? But the reality is, the answer can have some pretty huge financial consequences. Today, we're diving deep into two of the most critical and, honestly, most misunderstood concepts in corporate finance: paid-up capital, or PUC, and the adjusted cost base, or ACB. Trust me, getting this right is absolutely essential for any investor or business owner who wants to avoid a tax bill they never saw coming. So here's our game plan for today. First, we're going to nail down the fundamentals of PUC and ACB. Then we'll look at why selling your shares to a buddy is totally different from selling them back to the company. After that, we'll get into a case study, a really common costly mistake, and then, and this is the important part, we'll show you the elegant solution to fix it all. We'll wrap things up with some key takeaways you can actually use. Okay, first things first. Before we can get into the strategy, we have to get the vocabulary right. To really understand what's going on, you need to know the two main players on the field: paid-up capital and adjusted cost base. They might sound like they're related, but they live in completely different universes. Think of paid-up capital, or PUC, as the company's number. It's written in their books. It's a formal accounting entry that represents the money the company received for an entire class of shares. Now, most of the time, this number just kind of sits there on the balance sheet, not causing any trouble, but it suddenly becomes incredibly important the moment the corporation decides to buy back its own stock. Now, the adjusted cost base, or ACB, that's your number. It belongs to you, the shareholder. Plain and simple, it's what you paid for your shares. This is the number you'll use to figure out your own personal capital gain or loss. So let's be super clear. PUC is the company's number for a class of shares. ACB is your number for your shares. And that distinction, it's everything. Okay, so we've got the lingo down. Let's see where the rubber meets the road. The amount of tax you end up paying can come down to one simple question: who's buying your shares? Is it another investor, or is it the company itself? As you're about to see, this single detail sends you down two completely different financial paths. You can really think of this as a major fork in the road. Path number one, you sell your shares to a third party, another person, another fund, whatever. The tax calculation is beautiful and simple. It's one thing, a capital gain. And you know what's great about capital gains? They're taxed at a preferential rate. But path number two, the corporation redeems your shares. This triggers a whole different set of rules. Suddenly, you have two separate, way more complicated calculations, and almost every single time, it means a much bigger tax bill. So let's look at that clean and simple path. Let's say you sell your shares for $200,000. Your ACB, what you originally paid for them, was $50,000. The math is as easy as it gets. $200,000 minus $50,000 leaves you with a capital gain of $150,000. It's straightforward, it's predictable, and it's tax efficient. This is what you want. Okay, now hold on, because this is where the path gets rocky. A corporate redemption. You get the same $200,000, but the tax math is from another planet. First, the tax authority looks at what the company paid you versus the shares PUC. Here, that difference is a whopping $150,000, and it's treated as a deemed dividend. This is the killer. Why? Because dividends are often taxed at your full personal income rate, which is way higher than the capital gains rate. What's left over is then used for the capital gain calculation, which, as you can see, ends up being zero. Same money, different buyer, and a much more painful tax result. Now, theory is one thing, but let's watch this play out in the real world. We're going to walk through a little story about a growing company that brings on 4 investors. They do everything right, except for one critical and very common mistake. They give everyone the exact same class of shares. So let's meet the crew. We've got Bob, our founder, a few years later, Ted, Carol, and finally Alice all come on board. They all get Class B shares. But here's the thing. As the company gets more valuable, each new investor has to pay more to get in on the action. So here's how it went down. Bob gets in for $100. A year later, Ted pays $150. Then Carol comes in at $200. And finally, Alice pays $250 for her share. Now, remember, they all have a different ACB, their personal cost, but they all hold the same Class B shares. That little detail is about to cause a whole lot of drama. And here it is. This is the heart of the problem. Because all 4 investors hold the same class of share, the PUC for that entire class gets averaged out. After Alice invests, the total capital is $700 across 4 shares. So the average PUC for every single Class B share becomes $175. Now, this is great for Bob. His original $100 PUC just got bumped up. But it is terrible for Alice. The $250 she just paid in gets dragged down to $175. This dilution is the source of all the pain. Okay, let's fast forward. The company redeems everyone's share for $250. What happens to Ted? Well, the deemed dividend is the $250 he receives minus that averaged PUC of $175. That leaves him with a $75 taxable dividend. The rest is considered his proceeds, and when you subtract his original cost, he's left with a small $25 capital gain. A mixed bag for sure. Now let's look at Carol. Her situation is even worse. She has the exact same $75 taxable dividend as Ted because that PUC is the same for every Class B share. But her original cost, her ACB, was higher at $200. This means she actually has a capital loss of $25. And here's the real kicker. You can't use that capital loss to offset the tax you owe on the dividend. It's just a horrible outcome. And then there's Alice. For her, this is a total financial disaster. She bought her share for $250 and it was redeemed for $250. She made zero profit. She broke even. But because of that diluted PUC, the tax system forces her to recognize a $75 deemed dividend and a corresponding capital loss. She made no money, but now she has a tax bill. It's just absurd. This quote really just says it all, doesn't it? It perfectly captures how unfair this is. Alice had zero economic gain, but the tax rules, because of this flawed structure, have essentially manufactured taxable income out of thin air. It's a fundamentally unjust and entirely avoidable result. So you have to be asking yourself, right? This is clearly broken for anyone who isn't the first person in the door. Could this all have been prevented? Can we rewind the clock and structure this company the right way so that everyone gets a fair shake? The answer is absolutely yes. So let's replay that entire scenario, but with one simple, profoundly powerful change. Instead of lumping everyone into the same class of shares, we're going to give each new investor their very own unique class. Just look at how clean and logical this is. In this much smarter structure, Bob gets Class B, Ted gets Class C, Carol gets Class D, and Alice gets Class E. By isolating each round of investment, that whole PUC averaging problem, it just vanishes. The PUC for each investor share is now perfectly matched to their ACB, the exact price they paid. No more dilution, everything is perfectly aligned. And now, let's see how this new structure treats Alice. The company pays her $250. The PUC of her specific Class E share is also $250. The result? Her deemed dividend is zero. Her proceeds are $250, her cost was $250, so her capital gain is also zero. The bottom line is as simple as it gets. No economic gain, no tax. This is the fair, accurate, logical outcome we were looking for all along. Okay, so after seeing that train wreck and the simple, elegant solutions side by side, what are the crucial lessons we need to burn into our brains? What do we do with this information? It really boils down to two vital takeaways. First, if your company is raising money at different valuations over time, you absolutely must use different classes of shares. It's the only way to protect later investors from this PUC trap. Second, read your shareholder agreements carefully. Be very wary of anything that forces a corporate redemption as an exit. As we've seen, having the flexibility to sell your shares to someone else is almost always the better tax move. So, I'll leave you with this final thought. The difference between a tax nightmare and a fair outcome often comes down to the planning you do on day one. Now that you're armed with this knowledge about PUC and ACB, it's a really good time to take a hard look at your own investments or your own business structure. Is it set up for success, or is there a ticking time bomb waiting down the road? Thanks for joining me today. I hope you found this valuable.